Australian dollar to US dollar is trading at 0.7046 right now, and almost every retail trader looking at the daily chart sees a strong sell signal and wants to short it. That is exactly the trap. The lower timeframes are screaming buy, and the RBA is about to drop a decision that a quiet minority of analysts still thinks could hold a rate hike for the third quarter. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, complete with stop losses, profit targets, and the single line in the sand that invalidates everything. Damn, why session bias is a range-bound tension with a bullish intraday tilt, but fading the rally into resistance, until we break one number. The daily trend is strong sell. The 1 hour and 5 hour trends are strong buy. This is a compressed spring. And the single invalidation level that flips this entire structure is 0.7036. Write this number down. 0.7036. If we get a 4-hour candle close below 0.7036, the hourly bull structure is dead, the daily strong sell resumes with full authority, and we are looking at a drop straight toward the 200-day moving average at 0.6889. That is the line where the herd gets trapped. Right now, the herd is leaning short because the daily chart looks awful. But the herd does not notice that the RBA pause is already priced in, and that a hawkish surprise, a minority of economists still calling for a Q3 hike, would blow those shorts to pieces. If 0.7036 holds, the squeeze that follows will be fast and merciless. Let's start top down, because that's how the institutions build their conviction. On the weekly chart, the trend is a buy, but it's weak. Price is sitting above the 200-week moving average, which is way down at 0.6889, but the 50-week MA at 0.7116 is acting like a ceiling. That 0.7116 zone has rejected price multiple times, and right now the weekly candle is struggling. The daily chart, however, flipped to a strong sell. We have a series of lower highs, and the moving averages are beginning to fan out bearishly. The 20-day MA sits at 0.7101, the 50-day at 0.7116. That cluster from 0.7100 to 0.7120 is a brick wall of resistance. The MACD on the daily is negative, with the signal line below zero and the histogram printing red bars, which tells you momentum is firmly with the sellers. But here's what most traders miss. The daily RSI is at 41. It is not oversold. That means the bear trend has room to run if it breaks support, but it also means there is no exhaustion yet, so chasing a bounce from here without confirmation is extremely dangerous. Now drop to the 4-hour chart. This is where the hidden divergence lives. On the 4H, the trend is a buy according to our oscillator, but the MACD is still negative and has not crossed above its signal line. The CCI is at -73, curling up but not yet above -100. This is a classic stealth recovery pattern. Price is trying to base, but the momentum indicators have not confirmed. The 20-period MA on the 4H is at 0.7080 and descending. That will be the first real test for any bullish push. The 60-minute chart is where the aggression is building. 1-hour trend is strong buy. The MA5 at 0.7045 and MA10 at 0.7065 are already curling up. Price just broke above MA5, but it's fighting MA10. The 100-hour MA at 0.7036 is the absolute floor. The fact that the 1-hour strong buy is building right on top of the 100-hour MA tells me that the short-term algorithm traders are defending this level with size. If that level goes, it's a failed breakout on the hourly, and the daily bears will smell blood. On the support and resistance side, your levels are razor sharp. Intraday support is 0.7036, then the S2 zone at 0.7010, and the final line in the sand is 0.6889, the 200-day and 200-week magnet. Resistance sits at 0.7065, the hourly MA10. Above that, the 4H MA20 and daily MA20 converge around 0.7080 to 0.7101. The breakout zone for the bulls is a 1-hour close above 0.7101. If that happens, the daily strong sell gets questioned and stops get run to 0.7150. I want you to look at the ADX, which is at 43. That is extremely high. A reading above 40 on any time frame signals a powerful trend in force. Right now that power belongs to the daily bears. But an ADX that high also means that if a reversal catches, it will be violent because the trend strength will unwind fast. That is the opportunity buried in this data, and the cross-linkage here is critical. Australian dollar to US dollar is trading tick 4. Tick with iron ore futures and the risk pulse out of China. The Australian dollar is the China proxy. When the S&P 500 catches a bid on soft landing hopes, the Aussie catches a sympathy bid. Right now, we are seeing a decoupling. Equities are holding up, but the Aussie is lagging. That underperformance usually resolves by the Aussie catching down if equities roll over, or by a rapid catch-up rally if risk sentiment improves further. Watch the S&P 500 E-mini futures tonight. If they break lower, Australian dollar to US dollar loses 0.7036. If they bounce, the Aussie squeeze is on. The news that changed everything in the last 24 hours is the Reuters poll showing Australia's central bank is expected to pause on June 16th, but a minority still see a Q3 rate hike. That minority is what the market is not pricing. The Australian interest rate swaps are only assigning a low probability to any further tightening. So if the RBA statement on June 16th retains even a slight tightening bias, the repricing in the Aussie dollar will be immediate and sharp. We saw a similar dynamic in the Reserve Bank of New Zealand recently, and NZD-USD ripped. That cross-linkage with NZD-USD is tight. Both antipodeans are trading like risk-on plays with a yield advantage, but the AUD has underperformed the Kiwi. That spread often mean reverts with RBA events. The 1 to 2 week directional lean is this: as long as 0.7036 holds, I lean long for a bounce into the 0.7100 to 0.7120 resistance cluster, purely on positioning imbalance. If the RBA surprises hawkishly, that target gets extended to 0.7200. If 0.7036 breaks, the lean flips to short targeting 0.6889. The event that invalidates the bullish lean entirely is a daily close below 0.7036. The event that validates the bearish breakdown would be a disappointing Chinese industrial production print or a sudden risk-off shock in US equities. Right now, the market is in a wait-and-see mode, which means the technical levels will be respected with surgical precision. Do you think the Aussie dollar holds 0.7036 through the RBA? Comment hold or break now. I'm tracking consensus live against the order book. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 strategies, from conservative to aggressive, with exact numbers that you can place right now on your platform. No ambiguity. Strategy 1, the sniper, conservative. This is the high probability play for traders who wait for confirmation. We only enter if the 1-hour candle closes above 0.7065, which is the current hourly MA10 and the immediate resistance. The logic: a close above 0.7065 confirms the hourly strong buy is taking control and that the bounce has genuine momentum. Entry on the close above 0.7065, or a retest of that level as support. Stop loss goes at 0.7025. Just below today's intraday swing low and beneath the critical 0.7036 level. That gives you a 40 pip stop. Take profit 1 is 0.7101, the daily MA20. Take profit 2 is 0.7135, a structural. Resistance from last week's breakdown. The risk reward on this setup is roughly 1 to 1.3 for the first target, and 1 to 1.9 if you scale out. This setup is void if the 4-hour candle closes below 0.7036 before your entry triggers. Patience is the edge here. The sniper, conservative, entry, 0.7065, 1H close above, stop loss, 0.7025 take profit 1, 0.7101 take profit 2, 0.7135 risk, reward, 1 minute and 1.3 seconds 1:1.9 invalidation. Void if 4H close below 0.7036 before entry strategy 2, the active trader, standard. This setup plays the mean reversion on a pullback to support, capturing the intraday bounce without waiting for a breakout. The entry condition. Price pulls back to the 0.7036 to 0.7040 zone and shows a bullish rejection wick on the 15-minute chart, ideally with a stochastic cross above 20. Entry at 0.7040 with a tight stop at 0.7018, just below the S2 pivot and a recent swing low. That gives a 22 pip stop. Take profit 1 is 0.7065, the same first resistance, for a quick 25 pip scalp. Take profit 2 is 0.7085, the 4H MA20. Once target 1 is hit, move the stop to break even and let the runner ride to target 2. This setup works because the active trader is exploiting the compression between the strong hourly buy and the daily sell. The herd is still short, and a dip into demand gets bought. This plan is void if price slices through 0.7036 with a 5-minute body close below it. No wicks, no excuses to the active trader, standard, entry. 0.7040, bullish rejection wick at support, stop loss. 0.7018 take profit 1. 0.7065 take profit 2. 0.7085 trail. Move stop to break even after TP1 hidden validation. Void if 5-minute body closes below 0.7036. Type your Australian dollar to US dollar range for tomorrow in the comments now. Let's see who's aligned. Strategy 3, the aggressor, high risk. This is the frontrunner's play, designed for a hawkish RBA minutes leak or a sudden risk-on surge before the daily close. The entry is aggressive, a market entry now at 0.7046, anticipating the hourly strong buy extends without a pullback. Stop loss at 0.7022, just 24 pips below, beneath the overnight low and below the 0.7036 floor by a small margin. Take profit 1 is 0.7101, and take profit 2 is the big level at 0.7150, where the weekly 50 MA sits. The risk-reward here is around 1 to 2.3 at the first target and 1 to 4.5 at the second. This is a high-risk, momentum chase setup, only for those who can lose small and manage risk aggressively. If the price breaks below 0.7036 in the next hour, you take the loss and flip to the short side. This is not a hold and hope trade. The invalidation is immediate. Any 15-minute candle close below 0.7036 and you're out. The aggressor, high risk, entry, 0.7046 market stop loss, 0.7022 take profit 1, 0.7101 take profit 2, 0.7150 risk, reward, 1 minute and 2.3 seconds 1:4.5 invalidation. 15-minute close below 0.7036. Exit instantly. Never risk more than 1 to 2% per trade. No positions through high-impact news like the RBA decision itself unless you have a defined volatility strategy. Stops are non-negotiable. This is how you survive to trade the next big move. The Aussie dollar can gap violently on a surprise statement. If you are in the aggressor setup, reduce size by half going into the release. The single most critical level for the next session is 0.7036. If this level breaks, the entire structure resets and we are heading to 0.6889. If it holds, the path to 0.7101 is clear and the shorts will panic. Tomorrow's wildcard is the RBA minutes and any pre-positioning flow during the Asian session. I'll be covering the full breakdown on Bitcoin and the S&P 500 divergence, and that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.